Welcome to another real estate industry update. I'm your host, Daniel Roccanti, here with Kyle Paxton. Today we got an interesting video. We got the one big, beautiful bill. So we are going to go over, it's a lot, so not everything, but we're going to basically go over anything that has to deal with real estate and a lot of real estate investors. There's a lot of information still coming out. There's a lot of guidance that still needs to be happened. So just kind of a small disclaimer here. This won't be everything. It will be a very high level, but we are going to try and get into as much detail as we can here, especially when it comes to some of these provisions that affect real estate and real estate investors.
Talk to us about individuals, Daniel. What are some of the big ticket items?
Yeah, so we're kind of breaking this bill down into a couple different sections here. So the first one is just kind of individuals. This is going to affect everyone. So whether you're in real estate or not in real estate, this is going to affect you. And just a quick reminder here, when Trump was first president and we passed the Tax Cuts and Jobs Act, a lot of what he made or that bill made was basically temporary, okay? Because of budgets and everything, they couldn't make it permanent, okay? So what this bill does is it kind of piggybacks off that bill, trying to make a lot of what that does permanent this time. But there's still some things that are temporary, right? And then there's a lot of stuff even beyond that. So even when we were researching this bill, some of the stuff surprised me, and I'm a CPA. I was like, oh, I don't remember hearing that in the news. So we're going to kind of go over just quickly a lot of the stuff that you probably already are part of the tax code right now, and they're just making it permanent. Okay, the first is the tax brackets, right? The top tax bracket is at 37%. They made that permanent going forward. It's not going to revert back to the old one of like 39.6%. The standard deduction stays the same. So it's still going to be around double of what it was pre Tax Cut and Jobs Act. So the high standard deduction, that's permanent going forward. They still personally repeal the personal exemptions. So no more of that. And then they are doing a little bit of beefing up here for the child tax credit, making that permanent going forward too with a little bit higher rate. All right. There's a lot of talks about 199A qualified business income deduction. What's going to happen there? Basically, everything stays the same. Still going to be a 20% up to 20% deduction. They did increase some of the thresholds and the phase out so people can get that easier. Especially if there's a specified service trade or business, or if they're limited based on wages and UBIA, things like that, they'll still get a chance of getting a lot of that. So a lot of the standard provisions are just being permanent. The mortgage interest, that's staying the same. And then they did add a few things that are kind of new. You probably heard about it in the news maybe. No taxes on tips, no taxes on overtime. There is a lot of limitations to this, okay? It's usually a bill only up to like $25,000, and it does phase out, so it's not for high-income people. There is also a deduction now for car loan interest. So that's very interesting. So if you're paying high interest on your car, technically you could be getting an itemized deduction for that adding that onto your house. So that is kind of mostly the individual ones. Kyle, do you have anything else to add there?
Yeah, I want to piggyback on, make a couple more comments on the 199A qualified business income deduction. I want to take a second to recognize that in some of the early versions of the bill, you may have heard they were considering increasing that deduction from 20% to a higher percent. They ended up settling at the 20%, which is what we know since 2018. And so that stays the same as Daniel mentioned. And then another big thing is that the estate and gifting exemptions, the lifetime exemptions, have locked in for the double unified credit. It's north of 13 million for 2025, and it increases with inflation. And so really what this does from our perspective, other than prevent a doomsday scenario in 2026, where a lot of these beneficial deductions were going to go away and we would have some hefty tax bills, is it just stabilizes some of our planning and eliminates uncertainty. So now is a great time to be touching base with your CPA on these things. Granted, we're still digesting this bill and we're reading it every day and trying to figure out how to actually execute on some of this stuff. But from a planning perspective, it adds a lot of clarity, and I'm very appreciative we've gotten that clarity in July and not December. So that's a big win from our perspective too. Um, but yeah, a
Yeah,
lot of good stuff.
increasing the state one, or not really increase it, but just keeping it what it was with the Tax Cut and Jobs Act. So if you don't know, when the Tax Cut and Jobs Act sunset, it was supposed to be cut in half. Okay, it keeps it at the same level, keeps indexing it for inflation. So now high net worth families that were worried about inheritance tax, estate planning, a lot of attorneys are happy. They were going to have a really tough year if they didn't pass. So we're keeping those high levels so more families do not have to worry about inheritance tax and don't have to rush to get all their estate planning done this year.
All good things. Let's talk businesses. I can set us up here. So, for real estate, I definitely want to focus on real estate in this section. Bonus depreciation is back. And we've had videos where we've kind of alluded to it, talked about it. I think we all kind of expected 100% bonus depreciation would come back. That is in the bill, and it is permanent for any assets that are acquired after January 19th, 2025. In the Tax Cuts and Jobs Act, we were scaling down 20% a year to sunset it with the phase out, and now that has been reversed. It's permanent 100%. So cost segregations are the name of the game in the real estate space, and those are back and big. Not that they ever went anywhere, but they're back in a big way. So
They definitely going to
beautiful.
pack a bigger punch going forward. 100% bonus depreciation. I will caveat it only effective after January 19th. So there's 19 days at the beginning of the year that is still only going to have 40%. Okay. Now that equipment could be eligible for 179. There are other ways to accelerate depreciation and get that full expense, but just realize that there is a 19 days. If you're wondering why that is, it's because Trump did not get sweared in until the 20th. So,
And
so there's 19 days of unfortunate, not 100% bonus depreciation.
and I want to hammer home kind of the impact of that. Generally speaking, as a rule of thumb, I'm totally estimating here, but you can usually get talking like a single family rental, right? You buy a property you're using for as a single family rental. You're reporting the rental income on your return. If you perform a cost segregation, you can potentially get a deduction for 20 to 40-ish% of the cost basis of the property you are acquiring. And I want to clarify that's a deduction, not a credit. So it reduces your taxable income, of which those income tax brackets we talked about before are taxed on. So the highest tax bracket, as Daniel said, 37%. If you're a taxpayer in that world, you potentially get a reduction in your tax bill in the year a property is acquired at 20 to 40% of the cost, 37% of 20 to 40% of the cost of the property. So, we do some projections and things like that to to model the impact of that and figure out if you hold multiple properties, it doesn't have to be the first year you acquire it. So we do a lot of modeling around what that looks like and how to optimize your tax bill with those planning strategies.
Yeah, the 100% bonus is back. We're really happy for that. That was going to be a huge planning opportunity for a lot of our tax people. But there's other stuff going on here. So the business interest limitation. So a lot of real estate clients unfortunately have to deal with this to see if they basically are going to get their interest limited and not be able to expense it. Well, they're being a lot favorable here. There was a lot of talks about whether you had to add back depreciation or not, what number you're using. So they did eventually switch this back to EBITDA, so they can basically add backs depreciation and amortization. So this is a much favorable win for real estate, especially large real estate funds that are always having to make this calculation and potentially getting their interest limited.
Yep. And another one that we see that doesn't necessarily impact the real estate space that much, but I think it's important to touch on is the restoration of the immediate expensing of R&D expenses, so research and development. We were in limbo for a little bit there and having to capitalize our research and development expenses and amortize them. over several years. And so expensing on that is back. That's a big deal for a lot of businesses. But again, doesn't relate super well to the real estate space.
Oh, we also should mention Section 179. That's still allowed. They did boost it a little bit. It probably won't matter as much now with 100% bonus depreciation. But there are a few items out there in the commercial real estate spaces, like roofs and HVACs, that you might potentially be able to use Section 179, but not be able to take bonus. And also for those first 19 days of 2025, you're still going to want to look at is Section 179 more beneficial than taking bonus. So just kind of keep that out there, that's another part of kind of in the business space to look at. So there's still a lot of deductions, accelerating deductions. So let's also talk about a little bit of the cons here. So we're talking about all this bonus depreciation, cost segregations. Now, there's some things this bill did that negatively affects real estate investors. So first, it never touched 1031 exchanges. So those are still on the table, okay? Thankfully, there's always talks about them, but thankfully, no one ever touched that. So cost segregations, 1031s, that's the play with real estate. But there was also a lot of incentives when it comes to clean energy, okay, or renewable energy, or something that's energy efficient. Well, there's a lot of talks about this bill about basically carving out a lot of those incentive programs. At first, there was mostly talks about, hey, this is only going to really affect like the residential stuff, the individual taxpayers who put in a nice energy efficient HVAC and things like that. And it wasn't going to touch the business credits, okay? This unfortunately touched the 45L credit, the 179D deduction, all right? So the 45L tax credit, this is for mostly home builders. So you can get a credit if you are building energy efficient homes, okay? So this is usually people building a substantial amount of homes. So a community, a development or something like that. If you're building energy efficient homes, you can get a credit per unit. Same thing with apartment complexes. The 179D deduction, if you're creating huge buildings that are energy efficient or you're designing for not tax exempt entities, governments, nonprofits, things like that, then you can get basically a deduction based on the square footage of it. So these are huge buildings. So there was a lot of incentive to go out there and create buildings that are very energy efficient. Okay. And these were substantial credits. If you were in that space, you were taking these credits. Okay. Or at least looking into it. This was temporary. It was supposed to phase out, I think in like 2032 or something like that. Unfortunately, this phases out now on June 30th, 2026. So we only have a year. All right. So the project has to start before June 30th, 2026. And then these credits go away. Okay. That's a pretty big hit for all the great things this bill does to real estate people. Unfortunately, it has a pretty big hit here. So if you're a home builder or you're someone that takes advantage of the 179D deduction, do realize those are going away, and you need to be planning to try and get what the projects you have to start before June 30th, get those planned out so you can get those credits. And then let's hope maybe down the road that they can revisit this, because that's going to be a pretty big hit for people in that space.
And we'll make a positive sandwich here to bring us home and talk about qualified opportunity zones being expanded. So this was a concept also introduced at the Tax Cuts and Jobs Act. And it was also, as with everything else we talked about, just about scheduled to sunset here. So Daniel, can you tell us about that expanding?
Yeah, so the opportunity zones, so yes, I gave you some bad information to end up giving you the best information.
I need to be happy,
all right?
Let's go.
That's right. So opportunity zones are back, and they're back in a even bigger way than they ever were.
I said back earlier. We gotta stick with it. Back.
Yeah.
Yeah.
And so I'm really happy about what's going to happen in opportunity zones here. This is something, the current law basically has it that opportunity zones were going to go away in 2026. Okay. So the original investment was going to have to be taxed in 2026. Okay. And then you cannot invest in any new opportunity zones. All right. So the original concept was you had a gain. It could be from real estate. It could be from stock sales, just any kind of capital gain. Okay. And you can invest it in an opportunity zone. That doesn't mean you have to start the opportunity zone. That means someone else can do the opportunity zone because there is a lot of red tape that goes around it. Okay. And then you got to defer that gain till 2026. Okay. And then your investment in the new opportunity zone gets 100% step up basis after 10 years when you sell the property. Okay. So you get a little bit of a benefit at the beginning. And then the real big benefit is holding the property for 10 years. Okay. And this is ways to make sure that you're holding your property and everything, and you're not selling it early. You don't get the benefits. Okay. So this was going away. What was going to happen? Well, what they basically decided to do is we're not going to touch the old opportunity zones. Instead, we're going to recreate opportunity zones going forward in 2027. Okay. So all the old rules still apply here. If you invest in an opportunity zone, that tax bill is going to be due in the 2026 tax year. Okay. And then you're still going to get the step up basis once you hold the property or the investment for 10 years. Okay. And then when you sell it. All right. There is some time restrictions on that. I think you have a maximum of like 40 years to hold it or something. But now they're creating a permanent opportunity zone. So this is not temporary. There's no deadlines. It is going to be a permanent, reoccurring, kind of rolling opportunity zone that happens every 10 years. Okay. And so what happens is it's going to have a lot of the same concepts as the original. You're going to have a gain that you can defer and invest into one of these opportunity zones starting in 2027. Okay. And it will be all new opportunity zones. So every 10 years, the state and federal governments are required to go in there and create new opportunity zones. Okay. Once you invest in it, it is deferred, the original gain, for 5 years now. So there's no set time. It's no 2026. It's just if I invested in 2027, I have 5 years and I'll have to pay taxes on that deferred gain in basically 2032. Apparently I'm just an accountant, not good at math.
Hey, this is
So 2030.
we're learning as we go.
I know. 2032. And so you do get to defer that gain, but just realize there is still a taxable event coming, just like the original. Now, once you hold it for 5 years, the original investment, you do get a 10% step up basis on that original investment. So that's kind of nice. It's a little different than the original. The original one, it had kind of 2 levels here based on if you held it 5 or 7 years. Just once you hold it 5 years, you get a 10% step up basis. That's nice. And now you're only paying basically 90% of the taxes that you would pay. And then you still got to pay your original gain there in 5 years. Then you still have the 10-year step up basis. Okay. And this is just rolling with you. So again, if I do my original investment in 2027, 2037, now I'm eligible for 100% step up basis. And that goes all the way to 30 years. Okay. That doesn't mean you have to sell the property between 10 and 30 years, but once 30 years, your step up basis is locked in at 30 years and you don't get any new step up basis. So even if you hold on to the property for a long, long time, you don't have to sell it. In the original one, you have to sell it. So there's the big difference right here. Okay. They are going to redo all the opportunity zones. They're also going to probably have stricter criteria on what is an opportunity zone. And they are wanting to focus more on rural areas. Most of the opportunity zones were all in urban areas. And so they're actually going to create new qualified rural opportunity zone funds. Okay. They are going to be more favorable for the investors. So the testing, the ruling is going to be a little bit more relaxed than urban opportunity zones. One of the big ones will basically be substantial improvement, which is you have to put 100% basis of whatever the building is and prove it. So if you bought a property for $1 million, we're not including land here. Okay. You had to put another $1 million in it. Okay. This, it's relaxed. It's only going to be 50%. So if I buy a property for $1 million, I only got to put $500,000 in it. So there's going to be a lot more relaxed. And they're going to increase the benefit because now you're going to get 30% step up basis instead of 10% for that first 5 years. So that deferred original gain, you get a little bit more of a deduction on that too. So really trying to boost up the rural areas. These are obviously areas that have a lot less people. So, who knows if the investments are actually good, but, you need to do all your own due diligence there, but do realize opportunity zones are back. They're in a big way and they're permanent going forward.
Back. Since Daniel overwhelmed us with positivity there, I'm going to two words of caution, or 2 points of caution here. The statute as it reads does not grandfather in a tract status for capital that's already been deployed. So there is the potential where a tract of land that is in a QOZ designated area could get removed. So that Daniel mentioned every 10 years, these things are going to be redrawn. So it's important from a planning perspective to pay attention to what's going on, look at political priorities, all that stuff, and just, to shore up that investment. Otherwise, you could walk into a trap to where now you start failing the QOZ test based on holding that investment. So that's down the road, but something to keep in mind. And then the other thing is we don't have any guidance on this to this point, but there are 2 new forms that are being issued as it relates to the QOZs that are information reporting forms. They are going to require more information than have previously, so it'll be more important, especially if you have a lot of tracts that are fall into QOZ status, to have good tracking systems around that. And then they had actually pretty significant penalties related to late filings of these forms. I was surprised by that. So know that these are going to be scrutinized a little bit more, and the stakes in the reporting are a little bit higher, along with some of these more beneficial provisions.
Yeah, I mean, the opportunity zones, though, they don't come effect till 2027. So we have some time here. We already have a lot of guidance because the first time around with the opportunity zones, and they're going to be a lot of the same stuff. But the nice thing about this year is because they're not effective till 2027, the IRS actually has time to give us real guidance going forward on this, instead of us, like last time, where we're all just trying to rush and figure it out. So that's something to think about, is if I got gains coming up, 2027 is the year to start considering opportunity zones again.
And while we're here talking about it, again, I want to emphasize the point of planning around your tax picture. We talked about how the existing QOZ investments are going to trigger gain in 2026. Keep in mind connecting that with cost segregations, some of these other beneficial provisions that are coming back, you can use to offset some of that gain we're going to trigger. And so be in touch with your CPA and make sure that you're staying proactive and planning around these provisions.
Yeah. And one last provision that I forgot to mention earlier was the SALT deduction. There's a limitation on $10,000. That's getting up to $40,000. Okay. It does start to phase out for high earners, but it's still, no matter what, you'll always get at least $10,000 deduction. Okay. But the best part about this is there's a lot of talks about it basically removing pass-through entity tax entities, so PTETs. So it doesn't do anything with it. Those are still around. So people that have real estate in states with taxable state taxes, and potentially have investors and things that are dealing with this limitation, still going to make sense to file the PTET, so you're maximizing deduction for your owners and investors in your real estate.
That's all I got, Daniel. Let's get out of here.
So overall, there's a lot going on in this bill. This bill right here affects more middle class than I think was originally expected. It does affect a lot of real estate and business owners, but there's a lot in here that just affects just general middle class. So it is a big win for a lot of employees, where the first time around the Tax Cut and Jobs Act was mostly focused towards business owners. Thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe, as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investment. Till then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.